Welcome to this explainer, where we're going to completely expose the illusionist's playbook of stock market manipulation. We're going to show you exactly how these tricks work behind the scenes. Think of this as pulling back the curtain on a massive magic show. You see, while the stock market is generally a place of legitimate investment, there are certain players out there who use highly deceptive tactics to create absolute mirages. They're tricking you into seeing value, or maybe seeing panic, where neither truly exists. So today, we're giving you the ultimate guide to spotting those illusions before you fall for them.
To really understand the stakes of these schemes, we have to start with this staggering number, an estimated $200 million. That's the amount of investor losses caused by just one man's boiler room operation back in the 1990s. When we talk about market manipulation, we aren't just talking about abstract financial theories, right? We're talking about massive, life-altering sums of money being literally siphoned right out of the pockets of everyday people.
And that man was Jordan Belfort. You probably know him as the Wolf of Wall Street. Years later, while delivering a motivational talk, he openly admitted, "I got greedy. Greed is not good," after orchestrating one of the most infamous frauds in Wall Street history. His story is really the ultimate cautionary tale of what happens when ordinary excitement and FOMO get totally weaponized by bad actors.
So here's our agenda for today. We're going to start with the wolf himself and the pump and dump. Then we'll look at faking market activity, rigging the information game, manipulating supply and demand, and finally, how to protect yourself. Okay, Section 1, the wolf and the pump, where ordinary excitement gets weaponized.
At its core, a pump and dump scheme is an emotional trap. Individuals or groups artificially inflate a stock's price by spreading positive yet entirely misleading information. They create massive hype. As more investors buy in because they think they've found the next big thing, the price skyrockets. The specific red flags you could actually catch in real time usually look like this: sudden unsolicited stock tips, wild promises of guaranteed returns, and incredibly heavy promotion of a company that has literally zero track record of actual revenue.
Using Belfort's firm, Stratton Oakmont, as a defining real-world example, the cycle is just brutal. First, pump up thinly traded penny stocks using a high-pressure boiler room. Second, feed the market a frenzy of misleading hype. And third, and this is the exact moment the dump happens, the insiders completely cash out while the price is artificially high. They walk away insanely wealthy, leaving everyone else holding a totally worthless bag.
But, the illusion always breaks eventually. The real consequences for Belfort? He was sentenced to 22 months in federal prison in order to pay back a jaw-dropping $110.4 million in restitution.
Moving on to Section 2, faking market activity, also known as the volume mirage. The first tactic here is spoofing. The mechanical trick is simple, but devious. Place massive buy-or-sell orders with absolutely zero intention of ever executing them. To understand the scale of how one trader's fake orders can ripple into market-wide consequences, look at Navinder Sarao. Working from his childhood bedroom, his fake orders contributed to the infamous 2010 flash crash, which wiped nearly $1 trillion off the market in minutes. Now, there is a genuine, ongoing debate among economists over how much damage spoofing alone can cause versus broader market fragility, but the deception itself is undeniable. It all happens in a flash. Fake orders create a false impression of demand. Other traders react to this fake data, moving the real price. Then the spoofer instantly cancels their fake orders and executes real trades to profit. For years, this was incredibly hard to track, but regulators eventually caught up, using advanced data analytics to spot those cancellation patterns, which has led to massive fines and real prison time for the perpetrators.
Another way to manufacture a mirage is wash trading. This is when a trader simultaneously buys and sells the exact same stock to themselves. It exploits a basic psychological shortcut. We naturally assume that if there's a lot of activity, it must be legitimate, creating a massive gap between fake trading volume and genuine investor interest. While heavily policed in traditional markets, this tactic has actually explosively resurfaced in newer, less regulated spaces like crypto to fake liquidity and bait new investors.
So, the specific signal that exposes wash trading is this: unusually high trading volume accompanied by minimal actual price movement. If millions of shares are suddenly trading hands, but the stock price is just flatlining, it is a massive red flag that someone might just be passing shares back and forth to themselves.
Let's dive into Section 3, rigging the information game. This is where secrets and sabotage come into play.
This starts with insider trading. Imagine the moment of decision tension. You are sitting on a massive corporate secret and you decide to make a trade before the public finds out. This practice completely undermines the basic premise that public markets are a level playing field. So how are they discovered? Regulators basically flag highly unusual, perfectly timed trades placed just days before major announcements. And what actually happens to people once they're caught? They face lifetime bans from the industry, massive fines, and years in federal prison.
Now, the exact opposite of the pump and dump is the short and distort. Here, manipulators take a short position, creating a direct financial incentive to spread bad news, whether it's true or not. What makes this so dangerous is that it blurs the line between legitimate critical research and deliberate sabotage. For an everyday investor, it can be nearly impossible to tell the two apart in real time as a stock plummets.
Section 4. Manipulating supply and demand. These are the brute force tactics.
One brute force tactic is a bear raid. This is an overwhelming, coordinated sell-off designed to break the confidence of everyone holding the stock. The key thing to understand here is the difference between a justified drop, where a company actually performs poorly, and a deliberately triggered one, which has absolutely nothing to do with the company's real-world value. The chain reaction mechanic is wild. Coordinated selling triggers automatic stop-loss orders. Those automatic sales push the price down even further, snowballing into massive human panic. The manufactured fear becomes a totally self-fulfilling crash. The only response that defeats it? A calm, fundamentals-first approach. If the underlying business hasn't changed, you don't panic sell. On the flip side, manipulators can hoard supply by cornering the market. To understand the sheer audacity of this, look at the Hunt brothers in 1980. They aggressively bought up futures contracts until they controlled an estimated 2/3 of the entire world's privately held silver supply. By dominating the supply, they briefly distorted the entire market's pricing.
But corners always break. The unraveling for the Hunts ended on Silver Thursday, with a single-day 50% collapse that bankrupted them. Today, because of strict position limits and the massive global scale of modern market structure, pulling off a corner like this is nearly impossible, but it remains a legendary cautionary tale.
Finally, Section 5. How to protect yourself. Let's build your defensive toolkit.
Because knowing how the tricks work is only half the battle. Here is how you actually protect yourself. Instead of getting swept up because a stock is trending on social media, always cross-reference that excitement with actual trading volume and price movement. If the volume is huge but the price is flat, just walk away. When a stock suddenly drops, build a rigorous habit of verification. Wait for official corporate disclosures before reacting, and remember that sticking to highly liquid securities with broad ownership makes it mathematically almost impossible for anyone to trap you in these games.
I'll leave you with this final, provocative thought. As you navigate the markets, take a hard look at your own portfolio. Are your decisions actually grounded in verified, calm fundamentals? Or are you letting the market illusionists pull off their next magic trick right in front of you? Stay vigilant, rely on the facts, and don't let the hype dictate your financial future. Thanks for joining me on this explainer.